If you walk past a billion-dollar skyscraper in Manhattan, you probably think the owners are elite hedge funds or billionaire developers. But as we slide through 2026, the very nature of who owns the world's empire is undergoing a quiet, digital demolition. What started as a tiny $1 billion pilot phase back in 2023 has exploded into a $24 billion institutional reality today, and it is on a trajectory to reach a staggering $16 trillion by 2030. This is the real-world asset, or RWA. Tokenization revolution. It is a massive, silent migration of the world's wealth onto 24/7 settlement rails, and if you're trying to build a career in finance or tech, this is the exact intersection where the next decade of alpha is being minted. To understand why the world's largest financial entities are rushing to digitize physical assets, you have to look at the incredibly slow, expensive plumbing of traditional finance. When you buy a stock or transfer money on a sleek app today, it looks instantaneous. But behind the scenes, a chaotic game of telephone begins. Your bank has to coordinate with clearinghouses, custodians, and private registries. This ledger reconciliation takes 2 full business days to settle, a legacy industry standard known as T+2. Now, imagine trying to sell a commercial office building, a private credit portfolio, or a high-yield corporate bond. These are illiquid assets. Trading them doesn't take days. It takes months of legal reviews, expensive escrow agents, appraisers, and mountains of manual paperwork. This friction acts as a massive trust tax on global capital. Traditional finance is essentially a collection of isolated databases that can't securely talk to each other without human intermediaries. But what if the ledger wasn't a closed book inside a bank vault? What if the ledger was a single, shared, globally verifiable system that settled trades in seconds instead of days? This is where the computer science majors and financial engineers are redesigning the system. To turn a physical asset into a liquid digital token, developers use 3 core structural layers: asset acquisition, the digital wrapper, and digital custody. First, a legal custodian secures the physical asset, like a multi-million-dollar corporate bond, and locks it in a regulated trust. Next comes the magic of the digital wrapper. Developers write a smart contract on a blockchain that represents fractional ownership of that locked asset. This isn't a speculative meme coin. It is a highly secure security token that embeds regulatory compliance directly into the software. If a piece of digital legislation dictates that only verified, accredited investors can hold this specific asset, the smart contract's code will automatically block any transfer to an unverified wallet. Finally, digital custody secures the cryptographic private keys to these assets, ensuring they cannot be manipulated or stolen. By combining these layers, we achieve a T+0 reality. The transaction, compliance check, and final settlement happen simultaneously, peer-to-peer, 24/7/365. If you think this is still a speculative sandbox experiment, look at the capital flowing into the system. With over $44.7 billion in FinTech investment flooding the sector in H1 2025 alone, the institutional landscape has shifted. The largest asset managers in the world, including BlackRock and HSBC, are no longer just looking at blockchain as a concept. They are actively tokenizing bonds and private credit to completely modernize their back offices. Why? Because moving trillions of dollars of illiquid assets onto a 24/7 ledger is the ultimate operational masterstroke. It removes billions of dollars in administrative costs, eliminates human reconciliation errors, and unlocks capital that was once frozen in settlement limbo. They aren't using technology to bypass regulations. They are using code to enforce regulations with absolute precision. But the most profound aspect of this migration isn't that it saves big banks money. It's how it democratizes access to wealth. Historically, the highest yielding asset classes, like institutional-grade private credit and premium commercial real estate, were locked behind massive financial barriers. You needed millions of dollars just to get an invitation to buy in. Tokenization introduces fractional democratization. Because smart contracts can divide a digital token infinitely at practically zero administrative cost, a student with just $500 can now own a piece of a high-yield corporate bond. You receive the exact same yields, security, and institutional-grade backing as a sovereign wealth fund, scaled directly to your budget. This is the essence of 21st-century financial literacy, using decentralized code to build a level playing field. But this massive migration has a major catch. Technology is only as strong as the legal framework that backs it. If a smart contract says you own a slice of an office building, but real estate law doesn't recognize the blockchain, your token is useless. This is why, in 2026, the frontier of FinTech has shifted to digital legislation. Landmark laws like the Genius Act in the United States and MiCA in Europe have finally cleared the air, turning digital assets from a speculative career risk into a secure, board-level strategy. And this has created a brand new, highly lucrative career path. The legal engineer. The highest earners sitting at the intersection of Wall Street and Silicon Valley are no longer just pure developers or pure analysts. They are the translators, professionals who can read risk logic to a board of directors, and smart contract logic to an AI developer with equal fluency. If you want to build a truly resilient career in this landscape, mastering this bridge is your ultimate competitive advantage. The RWA revolution is proof that the experimental era of FinTech is over, and the operational era has begun. The world's wealth is moving onto digital rails, and those who learn to navigate these bridges are the ones who will capture the future. But tokenizing the assets is only half the battle. Once you have a digital representation of a bond, you need a way to buy it. And that is forcing central banks around the world to build a completely new kind of currency. Which brings us to the next massive building block in your financial library: central bank digital currencies, or CBDCs. Are they a tool for ultimate economic efficiency, or the end of your financial privacy? Please like and share this video. Don't forget to subscribe to the channel as we continue to decode the future of the global economy. We'll see you on the ledger.